I will be your facilitator for the next 50 minutes, and joining me in studio today are John Kotzer, who is Head of Group Retirement Solutions at Old Mutual, Andrew Davison, who is Head of Advice at Old Mutual Corporate Consultants, Mpho Chipate, who is Senior Corporate Consultant at Old Mutual Corporate, and Luke Fraser, who is a Senior Intermediary Consultant at Old Mutual Corporate. Now, over the next 50 minutes, we're going to delve into understanding the retirement savings cost disclosure standards that have been implemented by the Association for Savings and Investment South Africa. And of course, all members of ASISA will have to be compliant of that by the 1st of September 2019. So our presenters this afternoon, John and Andrew, are going to unpack RSC and what this means for the retirement industry in South Africa. Please welcome John Kotzer.
Thank you very much, Siki, and good afternoon to all our webinar attendees. Very exciting to be presenting the retirement savings cost standard in this way. As Siki's introduced, I'm going to be doing a bit of context setting, and I would describe Andrew's session as the masterclass that will follow immediately after that. In setting the context for the retirement savings cost disclosure standard, I think it's best set out in 4 parts. The first part is to just give you some background as to how we have arrived at the point that we have arrived at today. And the first trend in that context is the undeniable and continued trend of standalone retirement funds moving to umbrella funds. Those of you in the industry in the late 90s will remember those figures quoted at one stage of there being over 15,000 standalone retirement funds. Well, at the start of 2019, that number reduced to below 1,000 for the very first time. At the same time, you can see how there's been growth in the umbrella fund market, although interestingly, even there over the last 3-4 years, there's been some stabilizing of that number and some consolidation. But that first trend is very clearly that more and more retirement savings is being saved within the umbrella fund market. The second trend is this whole consumerism trend, that drive for disclosure and making sure that customers, that members have the information that they need when they need that. And in an industry context, that gave rise in 2016 to the Treating Customers Fairly legislation, and the key outcome for us today is that disclosure standard, making sure that customers have the information that they need both before, during, and after the point of sale. The third trend talks to some of the unfortunate but very understandable consequences of how the industry has evolved in the context, in particular, of comparing different umbrella fund solutions, and within that, the cost component of umbrella funds in particular. So when one's looking at the costs, one is finding how costs are presented as rand per member per month, or percentage of salary, or percentage of assets. It got me thinking the other day, walking through Green Cross, imagine if we went into our favorite retailer for shoes, and instead of the standard price point of 889 rand for a pair of shoes, we were suddenly presented with the option of 50 rand per month for this pair of shoes, or maybe 5 rand per day worn. Or the more socialist response might be, let's look at a percentage of salary cost, and everyone could pay their little 0.5% of monthly salary for that pair of shoes that they're wanting to buy. Wouldn't that just be massively complex? Yet, we've inadvertently introduced some of that same complexity into the whole arena of comparing umbrella funds, and so that's one of the themes that retirement savings cost is looking to address. But before I go into the retirement savings cost standard in an introductory sense, I just want to remind you first and foremost that you mustn't see this in a standalone manner. And actually, this is just part of what is a holistic industry response. I've already alluded to the Treating Customers Fairly legislation from a 2016 perspective, and those of you close to the regulations will know how that's expanding into the Conduct of Financial Institutions Bill. A couple of years ago, our retail colleagues already introduced the effective annual cost disclosure standard. So all retail savings and investment policies, including RAs, now include that cost disclosure standard from an individual member perspective. Into 2019, and in March, we had the default regulations arriving, and Regulation 39 in particular already spoke about default investment portfolios, and within that, the need to make sure that costs were very well disclosed to all members, and retirement savings cost is very much part and part of meeting that requirement. So that brings us to where we are today, talking about this new 3-letter acronym that we're all going to be starting to use, RSC. But just to also look ahead and to remind you that RSC is a scheme measure, and from next year, October 2020, ASISA has already agreed that a member effective annual cost measure will be available for umbrella fund members too. So you can see this in the context of a holistic industry response. So that brings me to the third part of what I want to introduce to you this morning, and that is, what is this retirement savings cost disclosure? So on the screen now, you have what the broad table will look like, and as I say, Andrew's going to be taking you through the masterclass relating to that particular table. But in its essence, it is a cost comparison tool. Siki's already highlighted how this has been an industry-formulated measure coming from ASISA. And so the application of the standard is just for commercial umbrella fund quotes, because the commercial providers are all members of ASISA, and other non-commercial umbrella funds or standalone retirement funds do not fall under the jurisdiction of ASISA. Does that mean that trustees and advisors are going to start asking questions within that environment of retirement, those standalone retirement funds and those non-commercial umbrella funds? Absolutely. So I think all advisors and consultants can start preparing for that question from their trustees. It is a standardized cost disclosure, and that comes with some pluses and minuses, but obviously you do want a standardized measure, and Andrew again will take you through the detail of that. And importantly, you're going to start focusing on costs in a percentage of assets manner, which is something a little bit different, a little bit new. But the reason for that is linked to the fact that on the plus side, your investment returns are obviously expressed in percentages of asset terms, and so it does make sense to take all of those costs. And even though industry participants can still charge them as rand per member per month and percentage of salary, we are now simply converting that back into a percentage of assets standard as part of this disclosure. And Siki has already shared with all of you that it has to be in place by the 1st of September, and I can confirm that for Old Mutual Super Fund quotes, that went live on Monday. So those of you who've already started requesting new quotes will already have started receiving the new disclosure standard within the Super Fund quotes. And lastly, I just want to remind everybody, not that I need to, that when it comes to looking at umbrella funds and assessing the different value propositions out there in the industry, it's obviously a reminder that that comparison is more than about just cost. And to answer that question for ourselves, Old Mutual already conducted a very thorough survey at the end of last year in preparation for retirement savings costs to ask advisors, to ask the current industry participants, just what are the main selection criteria that they consider when assessing umbrella funds. And yes, you can see again from the slide that cost is a very important factor, but equally important are all the other dynamics mentioned on that slide, with investment performance and the underlying investment factors absolutely held at the same level as costs in terms of making that decision, as well as looking at features such as benefit flexibility, how well is the fund being administered and serviced, and looking at other sponsor and governance-related factors. So within the super fund quotes, you will see how those proposal documents from Old Mutual have already been enhanced to address not just the retirement savings cost disclosure standard, but actually all the criteria that industry regard as important. So with that as context, I'm going to hand back to you, Siki. Thank you very much.
Over to you, Andrew.
So as John has already alluded to, I'm going to be digging a little deeper into retirement savings costs and giving you a sense of exactly how this new tool that is going to be at the disposal of our clients, how can it be used? And as I have already said, it is a tool. It's another tool, but it is only one tool that captures one aspect of what is important about a fund, being the costs. It is important that we don't actually distill everything and reduce it down to cost alone. It's very important that we consider the full value add of a particular umbrella fund or a particular fund when we're looking at using that for our employees. So retirement savings costs, just maybe to come back to John's comparison with the shoes, I think maybe to murder that analogy a little bit, when you're investing in a pair of shoes, it's important to consider not just the cost. First of all, is it going to fit you? If you put your foot in and it's not the right size, that's a problem. Secondly, you need to think about the comfort. Is this a shoe that that's going to be comfortable? There are also other things such as the speed of withdrawal of your foot from the shoe. Very important when you're thinking about the kind of shoes that you're looking at. And also, if you bought a pair of shoes that is good for work, can you then also maybe go for a run in that pair of shoes? Or have you bought a one-size-fits-all that doesn't actually adapt to your needs? And then one final example, if you're buying shoes for someone like Shaquille O'Neal, is that pair of shoes going to grow with you? Because if it does, rather than staying the same size, that's a much more valuable pair of shoes to have, obviously, when you get to size 22. So costs is one aspect. It's very important, but it's not the only aspect. This is the table that we're all going to have to get very used to in terms of retirement savings cost. And really, there are a few important features about it. The first is there are 4 important components. So the costs have been broken down into 4 different categories. And it's important to consider each of those, first of all, as well as the overall cost. And then secondly, very importantly, it is also shown over different time periods. So as you can see in this example that we've got here, there are 4 different time periods. 1 year, 1 to 3 years, 1 to 5, and 1 to 10. It's not 1 year, 3 years, 5 years, and 10. In other words, it's over different lengths of time, not particular years. It is over a different time period. And the reason for that is to give us a sense of how those costs will have an impact over different time periods, because there are certain costs where the impact changes. So for example, if you have percentage of assets, that is likely to be fairly consistent as a percentage of assets over time. Whereas if you have a rand per member per month fee and the assets are growing very rapidly, that rand amount is going to become a lot less significant in terms of its impact on your asset accumulation. And one other important point is we've got these fees or these costs as a percentage of assets. And you might say, why? Is that the best possible way to do it? And actually it is, because what's important when you're saving for retirement is the asset accumulation. Are you accumulating enough assets to retire comfortably? So as a percentage of assets, that is obviously something that is holding back your accumulation of assets. So that is why RSC is shown as a percentage of assets. So let me dig a little deeper into each of those components. The first one is investment management. Obviously, this is everything to do with the investment of the assets. Any fee that relates to that, you need to include it in this particular row. Where there is a change in the default between when you first quote and then maybe where you settle, when you actually finally decide on the default in that particular scheme that you have, you do need to potentially, if there's been a change, get an update on the investment part of the RSC, because the fee may be different from what was initially quoted. Also, if the default happens to consist of more than one portfolio, you do also need to have a weighted average of the costs associated with those. Importantly, these fees for investment management are based on TERs. Okay? So even if you're not in a unit trust where TERs are a requirement, you will need to get the equivalent of a TER to be able to build it into the investment line. The second one then is advice. Okay? So this is about commissions, it's about consulting fees, anything relating to advice. It's not just EB consulting advice, it might be asset consulting as well. Whatever advice is being given to the scheme, that needs to be included in this line over here. And then there's the administration, obviously all about the record keeping. Importantly, this should not just be driven by the basic admin fee, which might be a rand per member per month fee. It might include a scheme fee, which is also an admin fee. It might also include a fee that is an investment administration fee that is not for the investment management, it's for the investment administration. And quite often you do have a percentage of assets fee that would come through here. So it doesn't mean that all administration fees are of one particular type. And then the final category is kind of a catch-all. It's the other. So there we've got a whole bunch of things that are not covered by the above 3. I'm not going to go through all of them. Importantly, from a smooth bonus point of view, the capital charge would be separated from the investment fee. the investment fee would come in the investment management line, and the capital charge would come through in the other line. Okay, so what that means is that a smooth bonus portfolio, you might see an other line which looks a little bit higher than other portfolios because they wouldn't have that capital charge. Okay, so important to know what is fitting in each of those 4 categories. Then an important thing to pay attention to will be the notes. So I've just highlighted here, next to each of those, there will be a reference to a footnote. The footnote will then contain any details that you need to know about how those fees have been calculated, or particular or specific assumptions or things that have been included. So pay attention to the notes. They will contain important information quite often. So that really is the nub of the 1 year numbers. So as you can see there, I've just populated this table again just to show you. Importantly, we need to make certain assumptions when we're calculating retirement savings costs, because what we're doing, remember, is we are taking a scheme, we are projecting the assets, we're deducting the fees depending on what basis we're using to calculate a particular fee. We're adding up the fees for a particular year, and we're dividing by the average asset value in that year. It's as simple as that. So retirement savings cost is not tricky, but we do need to make some assumptions. And again, we need to ensure that those assumptions are consistent for comparison purposes. So they are dictated. You do need to use these assumptions over here. Investment return of 6, salary escalation of 6, and price inflation of 6 as well. So you might immediately be thinking, a gross investment return of 6 in the current environment, first of all, sounds very generous. But actually, in the long term, we would hope to get a lot more than inflation from our investment strategy. Probably in a balanced long-term strategy, we would hope to be getting around about 5 or 6% above inflation. What that means is that for a portfolio where the asset value grows fast because investment returns are doing well and inflation plus 6 is the kind of number that we're earning, the RSC is obviously not going to be very accurate, because the assets have grown a whole lot faster than what we projected in our RSC calculation. Okay, that is a feature of the need to have a consistent comparative basis. Okay, so it does mean that everyone's being compared on the same basis. Unfortunately, what it means, though, is that if you have a very conservative, simple strategy like money market, which might only give you inflation or a return in line with inflation, and you're comparing that to an RSC where the underlying investment strategy is a whole lot more aggressive, that comparison might not be entirely accurate. Okay, so you do need to bear these sorts of things in mind. Secondly, all existing assets that need to be transferred via Section 14 or whatever the case might be need to be included in the calculation. Also, you do importantly need to exclude group risk. Okay, so the retirement savings cost is only about the retirement savings component. Ignore the risk completely. Any costs, commissions, and risk premiums need to be excluded from the RSC calculation. Okay, so it's not about risk costs at all. And then, importantly, there are also no member movements that are allowed for. Okay, so in other words, you assume whoever's a member of the fund on the day that you're getting the quotation, that is the membership that you will project for the full 10-year period. So again, what you need to bear in mind when you are advising a client, if you're an intermediary or a consultant, is how realistic are the assumptions relative to the client that I have. So if the client is a startup, fast-growing company, well, RSC is pretty meaningless. You're still going to have to do it, but it's not really going to give you a whole lot of information that's relevant to that particular client. Okay, so these are the important things to bear in mind, because RSC does have some drawbacks, but as long as we keep those in mind and we interpret the information accordingly, there's no problem with that. Okay, you also need to include VAT, and you can choose whether you want to show 1 or 2 decimal places. Okay, then as I said, we do need to do this for the 1-year period, but we do need to do it over other time periods as well. And the reason is, as I said earlier, the time period does have an impact depending on the type of fee. So if it's a percentage of assets and there is no sliding scale applied to the portfolio, that percentage of assets is likely to remain pretty flat. However, if it's a rand per member per month and the assets are growing fast because of the contributions and the growth, your rand fee as a percentage of assets will reduce over time. So that is important. That kind of fee might be more appropriate or attractive for a fast-growing fund relative to an asset-based fee. However, if you're a startup fund, an asset-based fee, because you've got no assets to charge any fees on, might be quite attractive. Okay, so again, when you're advising a client, think about the nature of the client and think about what is appropriate in terms of fee structure and the type of fee for that particular client. Okay, so as I say, we show that over different time periods. We can see the impact over time of the different types of fee. And then finally, once we've done the scheme level disclosure, we need to do the member level disclosure. And you can see here there are 9 scenarios, basic, typical scenarios of a typical kind of member. Okay, so in other words, it's not specific to each individual member. That is EAC, which will be coming in 2020. For now, it's all about the sample members. Okay, so you can see here on this table, on the left-hand side, current member share, we've got 3 different member shares, 0 to 100,000 and 500,000, and then 3 different levels of salary, 60, 240, and 600,000 a year. You can see there, if you've got no assets, your RSC is going to be very high because you're talking about it as a percentage of assets. And when you take something as a percentage of no assets, it tends to be quite a large number. So those high percentages there, they're in the first block, 6.18%. It's because in the first year there are no assets to divide by, or very, very little assets. So when you divide a fee of even 100 Rand divided by assets of 1,000, that's 10%. In fact, in this example of 6.18, I dug a little deeper in here. The RSC in year 1 for that example, because remember we're doing it over a 10-year period here in the member level disclosure, in the first year, that 6.18 is actually 24%. So that is obviously skewing the 6% to a much higher number. So it looks horrendous when you first look at it. It's not something that I think we're going to have to get too concerned about. But the reality is some fees do have quite a big impact on the underlying members, and we also need to bear that in mind. Okay. So, quick example in terms of how we do this. So, just taking this example here, super fund choice. So it's a super fund example, stable growth, which is a smooth bonus portfolio, 100 members. The contribution is 12.25%, but we remember we're removing the risk premium component, which in this example is 2.25. So we're dealing with a 10% contribution. Okay, the salary per member per month is 16,000. Times 100 members will give us our total salary bill, and our current assets are 20 million for the scheme. Okay, so that's the example that we're dealing with. This is what the scheme input slide would look like, or graph table would look like. I'm not going to go into the detail. It's exactly the same as the example I've just shown you. This is how we will then calculate the build-up. Okay, the asset value at the start, 20 million. I've just told you that's what the assumption is that we used. Contributions, growth, investment growth, and then we've got our 4 cost columns. And those are literally based on the actual costs that are going to be charged for this particular scheme on the type of charge that we have. So whether it's Rand per member per month or percentage of payroll, percentage of assets, it's all built into the calculation. And then we calculate the total for the month. And then we roll it forward for the next month, and we do the same, and we roll it up until we get the fund value at the end, and we continue until we have a full 12 months of that calculation. As you can see, very simple. Even an actuary like John could probably do these calculations, but the point is they're not onerous. And in fact, what I would say is if you're an advisor trying to advise clients, you need to familiarize yourself with the underlying calculations. In fact, we are consultants, as Old Mutual corporate consultants. We have already built a calculator in Excel that can allow us to replicate this because we want to know how this is going to work and how it's going to impact our clients. So if you're an advisor worth your salt, you need to actually invest in a little tool that you can build very easily, and you can actually see the impact, play around with different scenarios, because it is important to understand how this is going to impact on your clients. As I've shown you here in this example, the average for the year is 21,298,000, the red value at the bottom left there, and you've got your total of each of the fees. You literally just take that total and you divide by the average asset value, and you've got your percentages at the bottom there in the colored text, and that's exactly what appears in the first column of the RSC table. Okay? We then repeat that exact same exercise over 3 years. So you can see there, I've summarized it here for the first year now. But this is now showing you year by year. So you can see there those green numbers in year 1 are exactly the ones I've just shown you on the previous slide. I'm going to dodge back here just to make life a little bit difficult for our technical guys. So the 0.62, 0.28, 0.19, and 0.73. Now we're going forward again. Okay, you can see those percentages there, exactly the same ones, but I've done the exercise exactly the same thing for 3 years, and you can see the average there in orange is the average over those 3 years. It's a simple average of those numbers over the 3 years, and then I can do that for the other periods as well, being 5 years and 10 years, based on this very simple table over here. So really simple to do. Graphically, this is actually how it looks. Again, very nicely laid out here, a little bit small, but if you're looking at the text on the webinar, you can actually take a closer look. Maybe if you're in the audience here, it might be a little bit small, but you can see there again, exactly the same numbers, 21,298 million is the average in the first year. You've got your 4 components there broken down into the different colors. Very simple to see how that progression of costs is building up over the 10-year period, but also how your asset value is building up. And then that's essentially as simple as it is. What's also important to note, we've already touched on it, is the fact that different types of fees will behave differently over time. Okay, percentage of assets will pretty much be consistent unless there's a sliding scale, as I said. However, fees like rand per member per month and potentially even percentage of salary will decline over time as a percentage of assets. Okay, so you can see there in this example, the light green and the light blue color, those are advice and administration fees. And as you can see, there's a slight downward slope on the fees. So over the 10-year period, you can see how they are actually reducing versus the percentage of assets fees, which are the pink line and the dark green. Remember, the pink line is other, which in this example is a smooth bonus example. So a big component of that is the capital charge. So it's a percentage of assets. So those two numbers are pretty flat. Okay. In a fast-growing fund or a fund where the assets are growing very fast, you'll see that this downward trajectory will be even steeper. Okay. Again, I'm just showing you the total output being the table at the bottom there. So really, in summary, as I've said, this is a tool. We need to embrace this tool as an industry and use it to our clients' advantage in terms of the decision making. However, we must not distill everything down to a cost. Okay? I have seen passive solutions that are expensive and passive solutions that are cheap, and I've seen active investment solutions that are very expensive and others that are cheap. So you can't just make it about cost. You'll end up in the wrong place. Okay? RSC does have its drawbacks. It's not perfect. I've tried to illustrate some of those. But again, if you understand the tool you're working with, and remember, this is a tool, as I've said, a tool is only as good as the workman that's using that tool. So you need to make sure that you understand the tool you've got in your hands and that you are using it appropriately, and then your clients will get full value. If you don't do that, well, it's going to be pretty meaningless. So I think it's on all of us as practitioners in this industry to do a good job with this new tool that we've been given. Different types of fees have different impacts. Again, I've tried to illustrate that. Again, we haven't got a lot of time to do this today. This is really designed to be a bit of an intro, and there is a lot more work that I think people need to do to understand RSC. Time horizon also has an important influence. Again, we've talked about that. The scheme can't be translated directly to members. So in other words, an RSC of 1.72 is not the RSC that applies to all the members of that scheme. Okay. And that we've tried to illustrate with the member level table. And then it's not all about cost. We've touched on that already. When you're looking for shoes, you don't just buy the cheapest pair in the shop. You first try them on. Okay? And you make sure you've got the pair that suits you the best. Thank you very much.
Thank you very much to both of you for that, the detail and the insights that you've given us. And you obviously also have a chance to ask some questions. We've already got a couple that have come through. I'll get to them in a moment. I'm also going to take some questions from our audience here in the studio. But before we do that, let me bring Mpho and Luke into this conversation. And Luke, let's just go back again and maybe reiterate what this means for advisors and other decision makers.
I think cost comparisons have been a huge bugbear for advisors and decision makers. It's always been an issue to compare apples with apples, and I think retirement savings costs will go a long way to alleviating some of that pain. But I think you can't just look at retirement costs in isolation. You've got to look at it relative to the performance of the particular portfolio that you're choosing. And as John alluded to earlier on, there's other things to take into consideration when comparing umbrella funds. You've got good governance, you've got solid administration, decent preservation and annuity options. So there's a lot to take into consideration, and retirement savings costs is just one of those considerations.
All right, and we'll dig a little deeper into that, because I think both Andrew and John have made the point that this is not just about costs. There's a lot of things to think about. And Paul, what is Old Mutual's view on rand per member per month versus the percentage of salary structure administration fee?
So we've done a lot of research around how members want their admin fees expressed and versus how employers actually want their admin fees expressed. So our research actually shows that for members, they want their admin fee reflected as a rent per member per month. On the other hand, it's important for employers for the cost to be expressed as a percentage of payroll, obviously because that creates a fair spread across your lower earners and your high earners. So having said that, we recognize that both are equally important. So I'm happy to say that under Superfund, which is our product, we offer the flexibility and the choice to employers to say, whether they want their cost expressed as rent per member per month or as a percentage of payroll.
All right, John, why is that important, the flexibility?
Yeah, I think you're coming into an arena where in an umbrella fund environment, you're wanting to give employers and decision makers the appropriate choice in the areas where it still matters. So on that theme of design flexibility, those are the areas where Superfund still puts that power in the hands of the management committees when it comes to designing your benefit design for your particular members. So you can see that in the context of the choice of risk benefits that we make available, and whether that's in an integrated or customized manner, the investment choices that you make available and how we package that. And likewise, to Paul's point, recognizing that different stakeholders have different preferences when it comes to how costs are expressed. Okay. And so keep that flexibility in place where it matters, but take away the governance and all of those other matters that previously took up time in a standalone retirement fund environment.
All right, I'm going to take some questions from the audience, so be ready for that. But before I take your questions, there's a couple that have come through on the webinar platform. Remember, you just type in your questions and click submit. Andrew, here's a question for you. It says, costs paid over and above the retirement contribution will be confusing if shown as a percentage of assets. Will it not be difficult for the average member to understand?
So I think that was one of the concerns about percentage of assets, and percentage in particular, is that people don't necessarily understand percentages. And as the question alludes to, is that those costs that are over and above contributions might not necessarily be linked to the asset value, and yet now suddenly you're seeing them as a percentage of the assets. But I think what's important, as I said, is that when we're saving for retirement, it's all about the value of assets that we can accumulate, and the percentage of assets is the most appropriate because that is what is actually detracting from us building up our assets. So I do think that there probably is a little bit of an education process for clients to get their head around it. I think a lot of clients have probably favored the rand per member per month. But what I think is problematic about that is they've only focused on one small component of the overall fee applicable to a scheme, which is being the admin fee. And I think there are a lot of other fees that maybe don't now come into the picture, which will with RSC.
All right, John.
There's a technical nuance to that question, which is that there are certainly some costs that don't flow through the fund.
Yeah.
And those won't appear in the retirement savings cost standard calculation, but there is a requirement to disclose that in the free text notes.
Okay. All right. Let's take a question from the floor. Any questions? Just tell us who it's directed to, please.
So my question is directed to John. And my question is more about the future of the retirement fund. So when you started by showing us what we have from a standalone point of view and what we have as an umbrella fund. I mean, if we have to put the numbers in there. The standalone, we're looking at about 778 billion, right, in the market. And the umbrella, we're looking at about 995 billion in the market. My question to you is, do you see standalone funds, do you think a standalone fund market is going to die over time? Given, again, we're seeing this RSC coming in, we're standardizing the umbrella funds. If I was a trustee from a standalone fund wanting to convert to an umbrella fund, is this RSC also helping me to make a better choice? What is your take on that? Do you see standalone actually going to be dying in the market?
Thank you.
I think in brief, Andrew's covered that to some extent by just highlighting that this is a tool. The tool is only applicable to commercial umbrella funds, but absolutely we expect consultants, advisors, and trustees of those standalone retirement funds to start looking at costs in an equivalent manner and use it again as a means of deciding is it appropriate for us to move from a standalone fund to an umbrella fund. So I think it's going to become one of the tools that's used in that process. Yes, I am still expecting there to be some more consolidation in the market, but where that will level off remains to be seen. But I do anticipate that 1,000 number will probably reduce to over 500 over the next 3 to 5 years. But even with the umbrella fund market, I expect to see some consolidation.
Right. Luke, I imagine this sounds like a very simple question, but it probably isn't. What is a good RSC number?
That is a good question. I think if you consider your average retail portfolios and the cost thereof, you're probably looking in the order of about 2.5%, 3%. If you consider generally institutional costs should be much cheaper, then for me the number is 2% or anything less. But I think, as the guys alluded to earlier on as well, we need to take into account that if you've got a brand new fund with no assets, you're probably looking at the order of between 4 and 6%.
Yeah. Paul, I talked about the compliance date being the 1st of September, but how do we know and how can we be sure that all providers actually comply with the requirements?
So I would like to bring this back home. So you think about the South African laws and how we just drive on the roads, and sometimes we think we're above the law. You know, you get stopped by a traffic officer. Instead of taking out your license, you take out that $50 note. No, I'm not saying I do that. But just to bring it back home, ASISA has made sure that all of us will be compliant. They've put proper guidelines in place. So annually, we're going to have to submit a compliance certificate, and it's not just signed by a nobody. So that compliance certificate should be signed by your senior executives within the company. So, for instance, the likes of your CEO, your chief compliance officer, your actuary, your auditors. So you know, in essence, no cold drinks, no bribery for ASISA. So yeah.
And there must be accountability and the seniority of taking this very seriously.
Definitely.
All right, another very quick question before we wrap up for you, Andrew. It says, with so many variables going into RSC, how are we going to know if every service provider is using the same information and assumptions?
Yes, I think that is something that we're going to have to keep an eye on. I mean, the intention is that there's a very clear set of assumptions, which is already we've shown. There's also a very clear input table so that you can see exactly what has been built in. But I do think there probably will be some small differences initially because it is still open to a little bit of interpretation. But I think most of that has been pinned down. So I don't think that there are going to be huge discrepancies. But I think it will be important to pay careful attention to that. Also, when you are providing the information to the various providers, so let's just say you're considering 3 or 4 umbrellas, make sure that you actually provide them with a consistent set of data about the scheme, and you don't exacerbate the problem by giving them different sets of information, because then you're not obviously going to get a comparative tool or a comparative assessment back.
Just rounding off on that question, just a reminder that every retirement savings cost disclosure that you'll see in the commercial umbrella fund quotes has 3 parts to it. It has the summary table, and then it has the RSC table in its own right. providing the numbers for that scheme, and then it has the member table just showing the impact on different members. So that summary table is really what advisors and decision makers must use to make sure that the same inputs have been provided to all commercial umbrella fund providers.
John, Andrew, Mpo, and Luke, thank you very much.